Financial markets look stable until they don't. Throughout history, the biggest financial collapses have struck without warning, triggered by hidden leverage, speculative bubbles, and decisions nobody questioned until it was too late. They reshape careers, destabilize institutions, and sometimes shift the global economy itself. Yet every major crash begins the same way, with small warning signs that are easy to ignore because short-term success looks too good to question. Understanding these moments isn't about dwelling on the past. It's about recognizing the early indicators that appear before the next collapse. These events aren't just numbers on a screen. They wipe out life savings, destroy global trust, and reshape economies for generations. In this video, we're breaking down the most dramatic market disasters of modern times, from Wall Street giants to crypto empires. We'll uncover the fatal flaws they shared and explore what their stories reveal about the risks that are still shaping today's economy, hiding just beneath the surface. Our first case is Enron, a company once hailed as a titan of innovation in the energy sector. Publicly, it was a Wall Street darling, posting incredible profits and revolutionizing its industry. But behind the curtain, a darker story was unfolding. Enron's executives were masters of financial engineering, using complex off-the-books partnerships known as special-purpose entities to hide billions of dollars in debt and inflate their earnings. They relied heavily on a controversial practice called mark-to-market accounting, which allowed them to book projected, often wildly optimistic, future profits as current income. For years, investors, analysts, and regulators bought into the illusion of unstoppable growth. But the deception couldn't last forever. As journalists and whistleblowers began to uncover the inconsistencies, the carefully constructed facade crumbled. Within a matter of weeks, Enron, once the seventh largest company in America, spiraled into bankruptcy, destroying the pensions and jobs of thousands of employees and sending shockwaves of distrust through global markets. Next, we turn to the collapse that defined an entire generation, Lehman Brothers. This wasn't just a bank failure. It was the domino that set off the 2008 global financial crisis. For years leading up to the crash, Lehman Brothers, a respected 158-year-old investment bank, had been gorging on high-risk, subprime mortgage-backed securities. The bet was simple: housing prices would continue to rise indefinitely. But when the US housing bubble finally popped, the value of these assets plummeted. The bank's balance sheet was suddenly loaded with toxic debt, and its losses mounted faster than it could find liquidity to cover them. As the truth of its insolvency became clear, confidence in the entire financial system vanished overnight. Credit markets froze, banks stopped lending to each other, and on a single fateful weekend, in September 2008, Lehman Brothers filed for the largest bankruptcy in US history. Its fall triggered a global meltdown that pushed the world economy to the brink. Let's rewind to the turn of the millennium and the dot-com bubble. In the late 1990s, the internet felt like a new frontier, and investors were caught in a frenzy of pure speculative optimism. The narrative was simple: the internet would change everything, and any company with a "com" in its name was destined for greatness. Billions of dollars flowed into technology startups that often had no clear business model, no profits, and in some cases, not even a finished product. Valuations soared to absurd levels, driven by hype rather than fundamentals. Companies were going public and achieving multi-billion-dollar market caps without ever having earned a dime. But eventually, reality had to set in. When these companies failed to deliver on their promised earnings, the bubble burst spectacularly. Between 2000 and 2002, the tech-heavy Nasdaq index crashed nearly 80%. Trillions of dollars in market value evaporated, and thousands of dot-com companies vanished almost overnight, leaving a trail of broken dreams and a harsh lesson about the difference between hype and value. Now for a more recent, and much stealthier, collapse: Archegos Capital. On the surface, Archegos appeared to be a modest family office, managing the private wealth of its founder, Bill Wang. But beneath this quiet exterior, it was operating with massive, hidden leverage. Archegos used a financial instrument called a total return swap, which allowed it to take enormous positions in a concentrated number of stocks without having to disclose its ownership. Banks, eager for the fees, extended billions in credit, unaware of the full scale of Archegos' exposure across Wall Street. When a few of its key stocks began to fall, the house of cards came down. The banks hit Archegos with margin calls it couldn't meet, forcing them into a fire sale of the underlying stocks. This fire sale triggered a chain reaction, causing the stock prices to plummet even further, which in turn created even bigger losses for the banks. In a matter of hours, the hidden leverage unraveled, causing over $20 billion in losses for some of the world's biggest financial institutions. And then there's the FTX collapse, one of the most sudden and dramatic failures in the history of cryptocurrency. FTX was marketed as a safe, regulated, and sophisticated platform for trading digital assets, attracting millions of users and celebrity endorsements. Its founder was seen as a visionary leader, shaping the future of finance. But the reality was chaos. A leaked balance sheet revealed that the exchange was propped up by its own illiquid token, and that it had secretly lent billions of dollars of customer funds to its sister trading firm, Alameda Research. When this news broke, it triggered a bank run. Users rushed to withdraw their funds, but the money wasn't there. Within days, the platform halted withdrawals and declared bankruptcy, revealing a shocking lack of internal controls, incomplete financial records, and the alleged misappropriation of billions in customer assets. The fallout shattered confidence across the entire digital asset world. Not all collapses take months or weeks. Some happen in minutes. That brings us to the flash crash of May 6, 2010. On that afternoon, the US stock market experienced one of the most bizarre and rapid declines in history. In the span of just a few minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, briefly wiping out almost $1 trillion in market value. The cause? A perfect storm of automated high-frequency trading. A single large sell order, executed by an algorithm, triggered a cascade of automated selling that overwhelmed liquidity in the market. As buyers vanished, prices went into freefall. Just as quickly as it began, the market corrected itself, rebounding almost completely by the end of the day. But the event served as a terrifying demonstration of how fragile our modern, algorithm-driven markets can be, and how quickly automated systems can spiral out of control. Different times, different markets, different assets, from energy stocks and mortgage bonds to dot-coms and crypto. Yet, as we've seen, the same fatal patterns return again and again. It almost always starts with hidden risk, where complex financial instruments or a lack of transparency conceals the true level of danger. This is often fueled by overconfidence and a "this time is different" mentality, where participants ignore classic warning signs in the belief that they've entered a new paradigm. And finally, you have systems stretched beyond their limits. Whether it's a company's accounting practices, a bank's balance sheet, or the very plumbing of the market itself. Every one of these collapses began quietly, with small cracks forming beneath the surface. And then, all at once, everything breaks. Financial disasters are an inevitable part of economic cycles. They will happen again. But every collapse, from Enron to FTX, leaves behind a trail of clues, a playbook of red flags that can help us recognize the next bubble before it bursts. The key is to remember the lessons of history, question the popular narrative, and always ask where the hidden risk might be. By staying aware and staying informed, we can better protect ourselves from the storms to come. Thanks for watching.